Hey Shane, how's it going?
It's going, man. Just got off the golf course, so can't complain too much. The market was down while I was on the golf course, as is the norm. So that's like a standard thing. Whenever I put on the I'm going to play golf during market hours away message, you can pretty much short it.
I'll have to pay attention for that next time.
Yeah, it's pretty normal.
Well, today's June 9th, and yeah, a big thing right now is tomorrow is the CPI data is coming out in the morning. So I'm kind of just watching markets and everything's just choppy. Seems to be consolidating. Uh, any comment on that?
Oh boy, I got comments for days on that. Where do you want to begin? What's you have a question about it, or what do you? Well, how about this? What do you think's going to happen? What's the prediction? What's the estimate currently for CPI? What was it last time? What do you think's going to happen?
Well, I think the estimate right now, so I'll go ahead and just get that back up here. But let's see, what is it?
I think it was
So
8.2 for year over year.
eight,
I
yep,
don't.
8.2 year over year.
And
So
last month was 8.3. Is that
yeah,
right?
that's right.
And that was coming down from 8.5 in the prior month. So last month showed a slight deceleration in the print, if I can remember right. Can you tell? Can we get that on TradingView? I wonder if CPI is I'm sure they got it charted in here.
I have to believe they would. Let's just take a look real quick. Looks like right here. Try and pull that up. Oh, so just the
Yeah,
chart of it, I guess.
yeah, I don't know. Maybe we'll have to do that another time, but I'm pretty sure it was 8.5 and then 8.3, and then they're expecting 8.2 this month. So, um, I think that's interesting. I mean, I've been saying that inflation had peaked for a while. I kind of saw that coming as of April, just because April was lapping very high CPI for last month, or for April of the prior year. So, when you start coming up against those tough compares, or the base effects start kicking in, it's harder to stack 8% on top of 8%. So, like, for example, when we get to next year, April is going to be lapping an 8.5% CPI print. Chances are it's going to be lower, just because it's difficult when those base effects kick in to continue an 8% trajectory. Now, inflation can go higher, but by another 8% year over year, that's I mean, if so, we're going to be experiencing a world of pain in this economy and country, and probably the global economy.
Mhm.
So, I I hope not. Anything's possible, I guess. But I'll tell you what, if you don't mind, can I share my screen real quick?
Yeah, go ahead.
Cool. So first things first is this is the Manheim Auto Index, which you can look up anybody online, and you can find out that wholesale used vehicle prices increased in May. The primary driver of CPI going down from 8.5 to 8.3 in the prior month in April was that used car prices had ticked down. So if I look at this, see this big drop right here from the peak of used car prices in like December or January. Well, used car prices were falling for the first part of this year, and now you can see that little tick up on the end. So that's May. And if you look a little bit deeper into the numbers, you can read about this in here. We won't go through the whole thing, but seasonally adjusted increased a little bit in May from April. And if you read on, it kind of says like the first part of the week was, or first part of the month was one way, and then at the end of the month, it started ticking back down again. So I don't know. I think that 8.2, so a continued deceleration of inflation, I think is actually going to be a little bit harder to do with used cars ticking back up again. And used cars make up a pretty good chunk of the number. And you can find that stuff out at the BLS. If you go to bls.gov and log in to look at the recent CPI numbers. You can just search for them in here, or we can put this link in the notes for you guys. You can actually see right here the not NSA is the not seasonally adjusted number. So 8.3 is what we saw last time. And if you click on this little deal over here, you can get 10 years of historical data. Actually, you can get a lot more. You can change it to get even more data. But what I was saying is that when I said base effects, right? April of 2021 is when we saw it start, inflation really start gearing up. So it went from 2.6 to 4.2. And then from 4.2, we went to 5 and 5.4, and then it was flat, 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 and then reaccelerated, 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 reaccelerated. And then finally, we printed a lower number for the first time since back in August of last year. So, could just be an anomaly, this downtick. We could reaccelerate again back to 8.5 or even higher in the coming month because, energy prices are skyrocketing. Used car prices are higher. A lot of the big components of the consumer price index are much higher than they've ever been, at least in my lifetime. We got to go back to, yeah, I don't know. I don't know. I guess it was early 80s. I'm an early 80s baby, so I don't know. I don't know what came first, inflation starting to come down or my birth, but not since I've been watching markets have we seen any prints like this. I mean, you can see, going back to 2012 just on this chart. These numbers are the highest that we've ever printed in my career for sure, maybe in my lifetime. And I do sort of think that inflation has largely peaked. Peaking is sometimes a process, doesn't just happen all at once, just like bottoming in the markets should be a process, shouldn't just be a moment. And so, maybe we'll bounce around in this 8.5 to 8.3 range for a couple of months, but I do think the Federal Reserve is going to have an impact with their tightening policies, reducing the balance sheet, raising interest rates. I think they're going to have an impact on the overall pricing environment, but it generally doesn't happen overnight, just like bottoms in the stock market generally don't happen overnight. So,
Right.
So who knows? I think it's a gamble to guess at what the number is going to be. Could be higher, could be lower, but I know one thing is pretty much certain. It's going to be high on a historical basis.
Yeah.
It ain't going back to 2. It's not going back to 4. It's probably not even going back to 8 even. So I think it's going to stay high, and that's going to give the permission to the Fed to continue aggressively tightening policy. It's arguable how aggressive they're actually tightening with these, starting out with quarter point hikes and 50-point hikes. It's kind of just BS to me. Like, interest rates are still not at 1% in the overnight market for federal funds. And that's pretty easy money by any historical standard. It's still stimulating the economy. So until they raise rates by a lot more, they're still very accommodative to business. And that gives inflation plenty of room to rear its nasty head. So yeah, I don't know. I think we're in a tough spot for our country and our economy, and the only way out of it is to experience some pain. And I wish that the Fed would just come and hike quickly, rapidly, all at once. A nice big number, send the markets tumbling lower in an instant, and then from there, a whole bunch of companies should go bankrupt. I mean, it's tough, but people are losing their jobs already. Microsoft is slowing down hiring. I got a whole list, actually. I'm keeping a list of all these different companies that are undergoing hiring freezes or even laying people off. I add new companies to the list pretty much every day. And I think that ball is kind of just getting rolling. So
Yeah.
Anyway, inflation is a big problem. It's going to stay a big problem. I think the Fed is at least taking steps to correct it, but I don't think they're acting aggressively enough in any way, shape, or form to do much of anything about it. So look for a high number when CPI comes out. And then as far as the market goes, initial reactions are kind of, hit or miss.
And, with that, why don't I'll just, if you don't mind, I'll switch it back over to my screen here. So this is what I'm seeing. We've just had this coiling for at least a week now on SPY, and placing a bet right now, high risk proposition. You're gambling really, but Yeah, we are stuck right in between this kind of 416 on the high end and was that 409 on the low end. I think that there's been enough consolidation there where we're probably going to get a pretty good move out of it. Higher or lower, I don't know. I think maybe I would bet on the lower side, but kind of a coin flip. I don't know if you've been looking at that at all.
Yeah, and I personally don't really think it's much of a coin flip. I think market's heading lower from here. I think that was a bear market bounce that we're seeing. I just think that's it's obvious to me, but I've got my bear goggles on, not my beer goggles. I've got my bear goggles on, and
Yeah.
everything I see through pretty much you know a bearish lens. I'm trying to get my chart ready to share with you
And
guys.
I was going to show for people if you're really trying to bet on the CPI print, if you go down to the hourly, you can really see the consolidation at a little more granular level. And looking at this today, we've kind of had this sell off. We're trying to rally a bit. I don't know if it's going to hold. If I had to bet, I think we're going to rally today, finish a little higher, and then I think it's going to roll over in the overnight. That would be my guess.
Yeah, could very well could be. Let me I'm going to share my screen again if you don't mind.
Yeah, go ahead.
Um, so this is what I see on the SPY. I see us, just hanging out here as the 50-day comes
Oh,
down. I think as long as we stay under the 50-day. Do you see my screen?
yeah, I'm switching over there.
Oh,
Now it's up.
all right, cool. So I see that we tried to bounce and rally, and we topped out right about here, and now we're just consolidating and watching this 50-day moving average, this red line come down. And as long as we stay below that, I'm going to stay bearish. What I also see if I pop my momentum indicator on here, what I see is also this coming down, materially. So it still shows bullish, momentum on some basis, but put in a peak here, it's coming down. Usually you see what happens as it peaks and comes down. Sometimes it's a head fake, but when you get this many bars in a row of declining momentum, even though it's positive momentum, I think what's likely to happen is this crosses to the red side. And as you can see, anytime you have red momentum, right? Like like in this area from here to here, the market was going down during that time. So I mean, this is the kind of stuff that I look for, right? So I'm looking at this area of negative momentum for the market, and this is what happened to the market during that time. It was down 12%. So to me, I bet you if I drew a Fibonacci line right there too, we would see about a 50%, retracement of that move, maybe even
Mhm.
only the 38% retracement of that move. And now we're running into a declining 50-day moving average. To me, this is a short all day. I think the Nasdaq is pretty similar. Um, I basically think that no matter what happens on the print for CPI, I think that over the course of the following day or two, which CPI happens on Friday, so we'd be looking into Monday, Tuesday of next week. I think it'll erase any pop that happens. Because here's the deal: is let's say CPI comes in higher than the estimate. So current estimates are 8.2. Let's say it comes in higher than that at 8.5 or 8.4 or hey 8.6. Any material beat to the upside, I would assume the market gets sold pretty much immediately because
Mhm.
the market will assume that the Fed is going to raise interest rates at a faster pace maybe than they're already threatening to do. So that's fine. But I think if CPI comes in hotter than expected, the whole market is going to sell immediately, just because the Fed's going to be more hawkish, or they think the Fed will behave more hawkish than maybe they've already planned on. So that's one outcome. And let's say CPI comes in lower than expected. So let's say it comes in at 8 or 8.1 or something like that. The market will initially will rise on thoughts that, oh, the Fed is bringing inflation down. The Fed probably has nothing to do with it yet because they're still extremely accommodative, like I said before. It's just a matter of the base effects kicking in, and inflation can't grow by 8-9% for that long. It's going to have to level out at some point. So I think that was already going to happen whether the Fed was raising or not. So anyway, point is the other option is that if CPI comes in a little lighter than expected at 8.2, say, um, it's still at 8.2. I mean, it's crazy. Look at what's going on at the gas station. Look at what's going on at the grocery store. My landscaping just went up 8%. They raised our fees. I have a storage unit in Eagle, Colorado. They went up by 25%. No, more than that. It was 75 a month, so 30%. It was 75 a month. Now it's 100. So up by 33% from last year, or from literally a couple of months ago for a storage unit. So I I just everybody's paying more, everything's costing more. It's not going to go away overnight. And so even if CPI comes in on the low end, under this 8.2 expectation, it's still over 8%. I mean, that's that's insane. Going back to this data here, where have we ever seen 8% before?
Yeah.
Only the last 2 months. So I mean, and the Fed's still accommodative based on their current, overnight lending rate. So I just think that there's so much more room to go. If it comes in at 8%, the Fed's going to stay hawkish. They're going to continue to unwind their balance sheet at a very fast pace. And we should get into that too. I mean, dude, there's so much to talk about. And it's not all
Yeah.
charts right now because charts don't really matter right now. There's a big thing, like the charts are in consolidation mode. There's nothing really happening. What's really happening is that everybody's sitting back waiting for the economy to figure out which direction it's going to go, and there's just nothing good about the economy right now. Nothing.
Right. I agree. And I don't know. Do you mind if I turn over and we'll kind of finish going through some charts here?
Go ahead. Go ahead. Sorry, I gotta close my office door. There's some fish getting cooked and it stinks to high heaven.
All right. So SPY, we've covered that pretty well. This is, if anything, probably a better spot to be short, but betting in front of a CPI print, probably not the best idea. And go over to the Qs, same chart. So between those two, nothing, but check this out. So I was going through charts last night, and I'm going to go to a weekly so we can see the big picture. But this is the Nikkei futures. Look at this. So consolidation, breakout, consolidation. And we just broke out this week. So, I'm not an expert on kind of where their economy is versus ours and all that, but I'm looking at this chart and that's one area that looks pretty bullish. And I know that you had that NetEase trade. What are your thoughts on that?
I don't have any thoughts on the Nikkei. I mean, Japanese stocks are dead money, have been since the 80s. So, I mean, if you zoom way out on that, you'll see that from the 80s. I think is when it was. The Nikkei is still down. So I don't know. I don't bother with it. I don't have any use for the Nikkei. It's just not something I watch. Looks like you're not going to get enough history on that
Yeah,
one.
I've got back to 2005, but
I mean, but I don't, it's just not something I pay attention to. People look at the dollar yen, I think the dollar yen is probably more impactful as an economic indicator than say what the Japanese stock market is doing. But yeah, dude, I defer to you on that one because I don't pay attention. I don't know how, I don't know. It's like a non-event in my world.
yeah,
Unless I were trading the futures, then fine. But I don't pay any attention to it whatsoever.
yeah. And this is one where, trading the futures, good spot to go, but it's just one of those where I don't know what's going on over there and I couldn't give you 2 cents on fundamentals, but that chart looks pretty nice to me at the moment, at least for a good trade for, a little bit. So, and then I'll go back to oil. So let me get it back to daily. I mean, this chart, again, the arrow holds true. It's just going higher and it doesn't seem to want to slow down for anything.
It's explosive. Yep. Long oil. I mean, you can be long oil and oil and gas names. It's pretty much the only sector of the market worth buying right now. I mean, you could blindfold yourself and throw darts at a list of oil and gas names. And the only thing I would tell you is to make sure you choose your exit strategy before you get in, know where you're going to sell, because when something goes up like this, it could keep going for a really long time. But when it comes down, it's going to come down really hard. It's going to come down way harder and way faster than it went up. And so it's gone up pretty aggressively and pretty violently. The XLE is kind of the same. And when it finally breaks and starts coming down, everybody in the world is at the same time going to be heading for the exits, and you got to follow your stops. So, you might get stopped out and have to buy back in as this thing keeps rallying. You never know how that's going to work out. But if I were entering the oil and gas market, I mean, as I think you guys know, I don't trade crude oil. I just don't. It's not interesting to me. I don't trade the actual commodities because I don't trade futures. And if I did, I certainly wouldn't get involved in crude oil, which is manipulated by a cartel called OPEC. I just don't think I have any edge there. I'm never going to know as much as those guys know, and they're going to continually pull the rug on people. So I don't see, with companies like Chevron and Exxon and Apache and EOG and on and on and on and on and on, all up hundreds of percent over the past year. I just don't see any reason to be in the crude market because as long as crude stays above 100 or really above 80 or 90, all of the oil and gas companies are going to make a lot of money. So I don't see any reason to trade oil, but the fact that it's going up puts kind of some wind in the sails of all the oil and gas companies. So your Exxon Mobil's and Chevrons and Shells and all those, they're all going to do great. So I prefer to trade stocks, not commodities, and I don't trade futures. So yeah, if I were going to do this, I would be buying oil and gas companies, and I would be pretty careful about where my stop was, and I would honor that stop the moment it hits. I wouldn't use any gut or feeling or it'll come back. None of that. You stop out, you sell, and then if you need to buy back in, even if it's higher. Who cares? Doesn't
Absolutely.
matter.
Yeah. So, we'll see on that one, but that's a very good statement is that you have to manage risk on this one because when it breaks, it's going to break pretty hard. So, take the momentum trade, but make sure you got that exit defined. So, and then we'll turn to gold. And again, this one, I don't like that one bit. I don't want to buy that. This
Loved it
is,
last week.
yeah. I did for a little bit. I actually even tried taking a long on that one, stopped out, and there's no edge in this. This is just chop. And if you wanted in part of your portfolio as diversification, that's a great hold. But trying to trade this right now, it's just that there's a lot easier charts. I'll say that.
Oh yeah, no doubt.
So, and then hit Bitcoin real quick before we go to rates. But back to this one, there's just still, I'm not seeing a whole lot of strength here. We're on support, and like here on the 6, you got a nice little rally, but gave it right back. And today we're just have this little green pimple, if you will. I mean, just nothing.
Yeah, that needs to go way higher before it's interesting at all. Right now, it looks again from a momentum perspective like it's just getting ready to roll over and make a new low. So I am not bullish on the coin. Actually, let me share my screen real quick here just to show you guys what I'm talking about. I think Kyle doesn't really pay as much attention to the momentum as I do, which is fine. It's not a primary trade indicator to me. It's a confirmation signal. So again, down here, I'm just gonna adjust this a little bit so we can make the MACD huge. Actually, I can kill the volume and then see how this thing works. It's negative momentum forever, right? One little blip to the green side failed and turned right back around and went down. Now we've seen a long stretch of positive momentum in Bitcoin, but Bitcoin hasn't gone anywhere during that time frame. I mean, it hasn't gone anywhere. It's been just stuck in a very small, tight range. If you want to draw it this way and maybe this way, it's just consolidating lower. And to me, if that were inverted, it'd be a great breakout. It means that it's probably going to go like once it gets into this little area, it's probably going to keep going the way that it was going before it got into that consolidation area. That's how technical analysis works, as you know, Kyle. But to me, with that long stretch of positive momentum and the stock didn't go up, that's a reason to be worried. you
Yeah,
know, like that is probably going to cross back to red before it accelerates to the upside. And as it crosses to, downward red momentum here, it's probably going to break out of this range. And, your target price would be, well, if it went up 26%, 26% upside there is probably close to 26% of downside here. So, you're talking about a price around 22,408 for Bitcoin. And if it doesn't stop there, who knows? I mean, there seems to me like that's a pretty logical place for it to go next. I mean,
yeah,
that looks almost too perfect. So yeah, I wouldn't bother being long Bitcoin for any reason.
absolutely. So, mind if I flip it back over to
Oh, you're
my
good.
screen?
We'll get better at this as we go. I don't know.
All right, so we've got Bitcoin. Take a look at rates, and we did find out. So these stats trail by 1 week, but when you're looking at this, I'm long right here, and when I look at it, I mean those are rates. So I guess I'm betting that rates are going higher from here, which no surprise there, but eventually that will catch up with the economy, the housing market, all that. But this chart just keeps pointing up.
Rates up. Type in DXY real quick. Check out the dollar index. Like zoom out on that a little bit first, if you don't mind. Sorry.
Yep.
You've got a little lag going on today, so I'm a little behind. But zoom out just a bit and look at how this thing has ripped. Now let's look at the dollar. That's plenty far enough.
Okay.
Um,
So you've got that and then dollar. I was looking at the dollar the other day. That is
so
definitely
it's pretty similar, to be honest. Kind of a trip, like third one. So yeah, now if you zoom in on
shoot.
this, you see how it pulled back just to the 50-day moving average, just like rates did, and now it's going to rip higher. Yeah, I think you zoomed out a little too far, but now you got to get
Here, we'll
back to
zoom
where
in.
you were. But
There we
anyway,
go.
the point is that this thing pulled back into that rising 50-day moving average. And so the 50-day moving average is support. It should bounce off that. As rates go higher, the dollar is going to go higher. Those are linked. Higher dollar is going to mean lower prices in the United States economy. And pretty much anything that's priced in dollars, all else equal, is going to go down while this goes up. We talked about that a bit last week. So this is what the Fed is doing. This is how they're going to bring prices down. And as they bring prices down, they're going to bring down the price of everything, just like they increase the price of everything by printing money and sending it off to people's mailboxes and stimulus checks and extended unemployment benefits and all those kinds of things. I mean, they printed all this money, reduced the value of the dollar, increased the price of things, including stocks and bonds. And now they're doing the inverse of that. And they're probably not doing it aggressively enough. So as they get more aggressive, as inflation remains stubbornly higher than it has been historically, the Federal Reserve is going to even more aggressively tighten, reduce the number of dollars in circulation. In fact, I was just looking at a chart. I'm going to switch back and try and grab the screen again here. I got to find my
Turning it
zoom.
over.
Got to find my Zoom window first, but anyway, yeah, I was just looking before. Where is it? Here you go. The M2, the money supply. This is a monthly chart, billions of dollars, seasonally adjusted. We won't get into that, but see this right here? March to April, we saw a downtick in M2 for the first time in any time since July of 2017. That's the past 5 years. In the past 10 years, it has not, did it tick down right here? No, it still ticked up slightly. Still ticked up during that little phase right there. There's no down ticks to be found in the supply of money at any time. This gray area right here is a little recession, right? This is the COVID recession, the shortest recession on record. If we go to the max, there are very few times when money supply was declining. We got a little one right here. I bet if you went and looked at what the market did during that time frame or shortly after, it wasn't pretty. And then of course they re-accelerated, increasing the money supply from there. So and look at how much they increase. Like this isn't even funny. I mean, this is how much. This is why inflation is high. You print all this money. Every dollar you pump into the market makes everything else in the economy cost more. It's not an immediate effect, but there's never been a spike like this before. That's why inflation is higher than it's been pretty much at any time in the history of our economy. And now it's starting to tick down because, as I said last week, as the Fed lets assets roll off of its balance sheet, they're taking the dollars in and they're basically lighting them on fire. They're taking them out of circulation, so they come out of M2. And as the dollar comes back down, or as the number of dollars out there come back down, the value of each dollar that remains in circulation is going to increase in value, and prices should start to go down along with money supply. So I don't know how far they're actually going to bring this down, but it's pretty interesting to see that for the first time pretty much ever, it's ticking down. So it's not a time where I'd want to be aggressively buying anything in the stock market or bond market.
Yep.
Cash is where you want to be right now. Gives you optionality for the future. Lets you sit back and your dollars are going to become more valuable. So hold on to them while you can until it looks like there's something else in the market that's going to become more valuable than dollars. And we're probably just at the beginning of that cycle, So doesn't mean the market can't bounce and rally and do this and that, but a general, bull market in stocks or bonds, it's just hard to see given the economic backdrop. So yeah, I literally, dude, I just looked at that right when I got home from the golf course. So you brought up a good point there, and so I just thought I'd share.
Awesome. Yeah, it's a lot of dollars out there. So we'll see. Then I'll take the screen back over here and we'll just finish up with some kind of individual stocks. And there's really nothing out there to update. The only one that's of interest here, Netties, you showed us that. It's I couldn't personally do this one, or at least you'd want small position size and have a nice wide stop here because it's pretty volatile. It's not the smoothest moving one, but continues to look bullish. So any update on that?
Yeah, but I'm not gonna try and use your screen to do it. So I'm gonna unfortunately flip it back to me if you don't mind. And I'll briefly hit on a couple of things with it. I'm ready to rock when you are here. Should be sharing. Can you see my screen yet?
I can.
Oh yeah, cool. Hey, I got a little message. I never noticed that before. All right, so NTES. So this is my view of it here, and I got the momentum on here still, but that's not too important. So this is where I would have got in, right, as it broke out from this level. So I've been in since I think it was this one right here. So I'm in at about $100, and if I added I'm just going to change this 50-day moving average to a 10-day real quick, and I'm just going to keep my stop right here at this 10-day moving average. And that's how I trade it. So now, if I basically got in on this day, this was my breakout, and you can see that the 10-day moving average is now up here at, call it 103. So, I'm in at 100, my stop's at 103, and it looks like I'm about to stop out if we close below this 10-day moving average for the day today. So we'll see what happens. I mean, I think it's just consolidating here in this area, and probably will break out again. But if it closes below this 10-day moving average, I might end up bailing on at least some of the position. I actually trimmed about 10% of the position on this candle here when it was dropping below the 10-day moving average intraday. It afterwards recovered, but I just didn't like the look of that, and it was right below essentially my cost basis of 101, 100, whatever it was where I got in. And so I did take a little bit off there. So I've got the rest of the position in. Going to trail with the 10-day moving average. If we close below that, I'll probably be out, or at least out of half of it or something like that. But ultimately, man, what I would say is, like, Let me actually flip this back to the 50 before I forget. Um, but one thing that I didn't mention yet on this call, and I think is worth mentioning, is that China is a great place to go invest right now. I don't normally say things like that, but check it out. I mean, you can go Google if you want all the different headlines about China being uninvestable. Um, they recently had their economy shut down. Shanghai was shut down. The largest container yard in the world was pretty much shut down, and the whole economy there was shut down due to COVID and their zero COVID policy. But it tried to break out yesterday, which I was watching, so it might take a little bit of time for us to actually see a breakout. And this is KWEB. This is the China large cap, or sorry, this is FXI. This is the China large cap ETF. You see it tried to break out there yesterday, kind of poked its head above, might be a failed breakout, might actually come back down here one time, and bounce again before it finally really does break out. But look at how far China stocks are down from the peak back in February of 21. China stocks went down 51%, to March. Since March, they've put in a higher low, right? A couple higher lows up here, right? But it was still down close to 50%. Today, still down 39% from those highs. And here's the thing. So they've already done their bear market. They already locked down their economy. Now they're reopening their economy from COVID, just like we were, right? When we came out of the COVID crash back in 2020.
Mm-hmm.
And we all know what happened in our economy as it reopened and people spent all that pent up demand got bought up. The market went much higher with it. But here's the other thing: is China's government is actively stimulating their economy. So they're pumping money into the economy, and it's going to have the effect of causing prices to go up across the board. So the Crane Shares China Internet ETF looks a little bit better, depending on how you want to draw the chart. But maybe in this area, so it's pretty much broken out. But again, it's put in a couple of higher lows already. And to me, it looks like this thing's breaking out. Probably will rise into the 200-day moving average and then fall back to this line before really breaking out. So I think you have time. I don't think you need to be in a hurry to go get this thing. I think it should take some time bottoming down here. But there's a long way to go to get back to where it was, right? There's a 215, 225% upside to get back to the highs.
Yeah, it's a long
And
ways.
yeah, you have a government that's stimulating their economy. They're pretty removed from what's going on in the United States of America. They got plenty of oil coming in at discounted prices from Russia. So the EU not buying any of that oil means that Russia's got to sell it somewhere. They're selling it to their friends in China, and China's not stupid. So they're getting it at a discounted price because they know Russia has no choice but to sell it to them. So while we're over here paying, $120 for a barrel of oil, China, I don't know what they're paying, but they're probably not paying for it in dollars, right? They're probably paying in rubles or renminbi, whatever they're paying in. And it's nowhere near the equivalent of $120 a barrel. So China is kind of the place to be right now. You've got the government stimulating, you've got cheap oil, you've got reopening happening, and you've got the end of a bear market. I mean, stocks are down 50%. Stocks are not down 50% yet in the United States. So we got a long ways to go before we get to that point. And here's the thing is if the SPY looked like this or the NASDAQ looked like this, it was down 50%. You know what you'd see in this country?
Fiscal
Stimulation.
stimulus.
Yeah,
Yeah.
you'd see him printing money and handing it out, and you wouldn't see inflation at the levels that it's at because every price in the economy will have come down. Companies would have gone bankrupt. Unemployment would have skyrocketed. So to me, China. So buy oil and gas and buy China. And check it out. Like, look at Alibaba. Alibaba is a great example. Great. I think it's a good company. It was down 76% from its highs at the low. Since then, it has put in some higher lows. It's bouncing into the 200-day moving average, pulling back a little bit today after a 12 or 13% run yesterday alone. So it wouldn't surprise me to see Alibaba come back down, to this 50-day moving average or to the purple line even. and maybe spend some more time consolidating underneath the 200-day moving average. But when this thing finally breaks out from the 200-day moving average back to the highs, you got 150% of upside in Alibaba. So there's and there's a bunch of other companies, in China that you could buy: NetEase, Tencent, SE. I could go on and on. JD is another good one. So all these charts pretty much look the same. They're all down big, they're all rising, they've all put in a higher low. And so I think it might be time to take a look and take a stab at China, because there's really not much economic underpinning of a bull rally here in the United States. So oil and gas and China are the places where I'm looking for longs.
Yeah, I agree. I like both of those. So cool. I'll flip it back over to mine. Like I said, just cover up or finish up with a couple stocks here, but nothing here, but maybe people are just kind of wondering what we're thinking. Apple, same thing here. I can't pick a direction, but that 138 level, that's still holding. And as long as that holds, nothing to report there.
Yep, I'm glad I didn't try and short it there. But yeah, if you look at the momentum on this thing, it looks the same as all the other ones that we just looked at, the SPY even. Like, we've had a bunch of positive momentum off the lows, but it's starting to roll over. It looks to me like momentum is going to flip to negative and take the stock back to its lows, take the market back to its lows, because it's a major component in both the S&P 500 and the NASDAQ. So I don't see any reason to be bullish. You got the 50-day now trading below the 200-day for the first time in a very long time. So hopefully we're in a bottoming process and it doesn't go too much lower, like down to that 109 green line that you have on there. But I wouldn't rule it out. I mean, if it wants to accelerate to the downside, we probably do go all the way down to 110 or 100 or maybe even 80.
Yep, I agree. And then Tesla,
What a
same thing.
turd.
I
What
mean,
a
it's just
turd this stock is.
stuck. So it's sitting right here. Hard. I
It's,
wouldn't want to place a trade short or long right here. I mean, maybe you could take a stab long, put an exit down here at like 693, but it's
I think you could do
still,
the same on the short side and put your stop at the recent high there. Like
yeah.
it kind of looks like almost like an inverse Head and Shoulders, which is a pattern I don't ever trade because I never make money on it. But you see two shoulders and a head there on the inverted side. So I mean, arguably the bulls would be saying it's an inverse Head and Shoulders. You should be long this thing. I wouldn't be, but that's me. So I think Elon belongs in prison and he's on his way there. Just a matter of time.
And then the last one here, Microsoft. I don't even remember what this was. So, okay, yeah, same pattern as all the others. Below all the averages,
Yeah.
50 is below the 200. Consolidating here. This is one where if you felt like it, yeah, you could go long here and you have tight risk, but odds are kind of against you. You're still just stuck under these averages. So
Yeah, man. I'd love to see that thing rally up into its 50-day. You see how it did that on the prior bump and it
mhm,
rallies into the declining 50-day and then just drops hard from there. So I guarantee if you pulled up the MACD, the momentum on this one, it would look exactly the same. Nice big momentum burst to the upside, and all it did was bounce a little bit. So yeah, it's going to bring out sellers. Everybody who wanted to sell before it dropped to its lows, now they get another chance to sell. They're hitting the sell button, and there's no volume in the market right now either. Like,
no.
it's summer, sell in May and go away is on. I don't see anything to get bullish about other than oil and gas stocks,
And Chinese
and
stocks.
China, man. I mean, I don't. United States technology is not where I would want to be. It just isn't. What does this thing trade at anyway? Statistic, like on the right hand side in that right bar, below your watch list. If you scroll down in that window and hit more financials, keep going. There you go. Oh, you missed it. It's
Oh,
by the
there's
bar
more
chart.
technicals,
By the bar chart. There you go.
more financials.
And then, yeah, and then go to statistics. So underneath the charts, there's income statement, balance sheet, statistics. So yeah, price to sales is still 10.58. Price to earnings 28.21. And growth is slowing. I don't know if you know this or not, but Microsoft came out and dropped its guidance, blamed it on Forex. So blamed it on the strong dollar. That's not what is going to cause them to make less money going forward. It's a funny thing to blame it on. But then a couple days later, they come out and they're like, "Oh yeah, also we're slowing down hiring." Um, uh, which has nothing to do with Forex. It's their business that's slowing. And so paying 11 times earnings, something where you could have bought it for 3.92 earnings back in 2015. Even at the end of 2017, after a major bull market rally, it only cost 5.6 times earnings. So paying 11, 12 times earnings for a company that's in, you know, a slowing growth mode due to the overall economic environment, it's going to be a really difficult way to make money. Microsoft's a great company. I'm not hating on the company. I'm just saying the odds are not in your favor at this point, for like picking the bottom, which is a stinky business. So,
Yeah, and
uh,
it's one of those things too. It's just that common saying, when there's blood in the streets, go out and buy a bunch of stuff. And it just doesn't hold. It's right now, this is just volatile, choppy market action, and it does not want to be trending higher. There's just better times to be putting money to work.
yeah, and
So it's
arguably there's not even blood in the streets yet. This has
no,
been mild. I mean, this is people don't even really care yet. Like we're not getting panic phone calls from clients at this point saying, "Oh my gosh, is everything okay? Is the world going to end?" Like that's when there's blood in the streets, and that's when you might want to think about taking a shot at a few things. Where people are still trying to buy the dip. People are
yeah.
still like, "Why do I hold so much cash? Maybe I should be buying this or that." It's like,
And
I don't know.
this has been, in my opinion, and kind of my lifetime of watching the markets, one of the more orderly sell-offs. Is we get some pretty good down days, but it's not one of those things like, when COVID hit and you're just
Breaking
sitting there
circuit
going,
breakers.
yeah, wondering where support even rests, if it's your keyboard or,
Right.
and, yeah, hitting circuit breakers, stuff like that. I mean, this has
Yeah.
just been, down 2%, kind of rallies up, consolidates, goes down a little more.
Yeah. No, it's totally not blood in the streets yet. But I hear what you're saying. I mean, I just because there's blood in the streets, it doesn't mean you can just go buy anything you want and win. Warren Buffett says that kind of stuff because he's very selective about what he buys when there's blood in the streets. He doesn't just go buy the index or buy every company in the index. He buys companies with good economics that are setting up for future gains based on what he sees coming over the next 6, 12, 8, 10 months, and then beyond that, to the decade level. So I don't have a problem betting on the United States economy in the long run, but there's not blood in the streets yet. So we're not even there yet.
Right. So,
I think we'll get there. I think we'll get there. I think here's the deal. Either we'll get there or inflation will remain insanely high and keep rising. I mean, so either the Fed's going to tighten hard enough to really break this thing and there will be blood in the streets when that happens, or prices are going to continue to rise. The poor people in this country are going to continue to starve, and it's going to create the worst income inequality, even compared to how bad it is now. It's just going to get worse and worse and worse. So I don't see that happening. I see the Fed, just like they stimulated for way too long. They were still buying bonds when inflation was 7%, for example, in February. They're still doing quantitative easing into the highest inflation we've seen in 40 years. Chances are they're still tightening when inflation has already come down enough and they don't need to continue tightening. They're always behind the 8 ball. Like they're like driving over Vale Pass looking only through their rear view mirror, which is stupid dangerous because they're looking at all this historical data from a month ago or a quarter ago and then basing what they're going to do today on that. And it's just, they're always behind. They're always behind. They're never going to help, any situation until it's already really got painful. So
yep.
pain is coming, man. Either because inflation stays, just insanely high, or because they finally get it under control and the market goes way lower with it. So at this point, cash is king. I think you should hold on to a lot of dollars.
Absolutely. I agree. So awesome. Well, thanks for your time again this week, and we'll catch up next week.
Yeah, man, there's a lot to talk about. I could keep going because this is I'm writing the market commentary. It's coming out I think tomorrow, so be on the lookout for that if you're on our mailing list, and if you're not, subscribe, shoot us an email, whatever, so we can get you signed up for the market commentary, and that'll hit your inbox once a month.
Absolutely. So awesome. We'll take care and see you next week.
Thanks, Kyle. See ya.
Yeah, bye.